What I'm going to talk about now is a bit of the M&A that we've seen. We'll talk about a bit of the hangover from M&A, which actually translated into divestitures, and the M&A overhang, which is just talking about how this divestiture scheme led by Newmont really had a little bit of a negative impact on other potential M&A as people waited for this to be over. So let's get going. So first, the rationale. So I've shown this graphic before, but all I'm trying to say is that here are the factors why people invest. In the gold sector, you want leverage to gold, you want to diversify, sustainable dividend. Not too many people want that, but the majors do. They want to offer that. Then exploration upside. That's really what the juniors here, most of them here, are for. Financing risk, that's what you take on. Trading liquidity, that's a big issue. And then operational and capital expenditures. So the operational part for a junior mining company, really, when you ask them, how much does it actually cost you to drill a meter? Then you realize that, okay, that money that you're getting, $5 million, will only get you maybe $1,500 meters. So bang for buck might not be a great proposition. So we're talking about the senior precious metals producers. That's what I've highlighted. And their big competition is not only the ETFs now, but also the streaming and royalty companies. Because if you look down the line, they offer leverage to gold just like an ETF. They're now offering diversification. They're much bigger now, lots of assets and everywhere. They offer some exploration upside. They're liquid just like an ETF. But they've got the risk of blowing out their capital and being exposed to higher operating costs. But what they're trying to sell you on is the dividend. The problem for them is the streamers can give you all of that without the OPEX and CAPEX issues and lower cost of capital. So even though that their competition is supposedly the ETFs, I think really their major competition is still the streamers and the royalty companies. But for them, there's fewer of them. But as we'll show with the mega mergers, there's fewer seniors as well. And one big takeaway from this is on the trading liquidity side. And I've mentioned this before, and I thought it'd be a good idea to say it again. It's inversely proportional how much you want to invest, not only your money, but your time, which is almost a bigger deal, and the liquidity of the company you're investing in. The lowest liquidity, you want to spend a lot of time. So you don't have that time, get a more liquid stock. That would be the biggest takeaway from anything you do. Because if you do have time to spend, then it's worth doing the juniors. But then you have to invest your time. And don't always proxy other people to take your time because they'll have their own biases. Okay, so moving up weight class. So recently, earlier this week, the BMO had their Miami conference. You saw a lot of deals happening, and one of them was Equinox Gold, all-share merger of equal transaction with Calibre Mining. And now this was a $7.7 billion union, Canadian, with a focus, what they're trying to sell you on is Canadian exposure with two advanced projects, one that just went into commercial production, Greenstone, and Valentine Lake, which is Calibre's advanced project in Newfoundland. Combined, now they have 24 million ounces of reserves, plan to get to 1.2 million ounces a year from 0.95 around that consolidated. But then the hangover from this will be the deleverage, prioritization of assets, divestitures, share structure, because they've blown out their share structure, obviously, and also fixing their balance sheet. So as you can see, they're both intermediates, and the idea is scale. And scale attracts a different investor audience and also lowers your cost of capital. And that allows them to build cheaper. That allows them to do projects that other people can't do, mostly the intermediates or the single asset developers or even the single asset producers. So what Newmont did was they went mega with respect to getting Newcrest and prior to that Goldcorp. We'll also touch on a little bit of Anglo because Anglo bought Centamin, single asset developer in Egypt, carrying a lot of geopolitical risk, higher cost of capital. Anglo Gold takes it over, lowers that cost of capital for that project going forward. So if we look at that, Anglo Gold Ashanti came out with their full year, and you could see leverage. So that is $942 million of free cash flow, not revenue, from around 119. So almost a 9 times increase in free cash flow. And most of that, all of that, was the gold price. That's exactly what people are looking for. Very little had to do with sentiment at that time because the absorption of that company and getting it onto their balance sheet took a little bit longer. So not much increase in sales volume, but the big deal was the gold price. So that 25% increase in the gold price got them a 9 times increase in their free cash flow. Will that keep going? Probably not. That's why, as you look at the share price, it did very well coming up to that time. It was up about 46%, got up to a peak of US $33.60. And so, and that was the acquisition of Centamin, this $2.3 billion acquisition of Centamin, the biggest deal with that was the reserves. Because if they didn't have that, their reserves would be depleted year on year. They wouldn't have an increase in reserves. So the M&A masked the issue that they're not growing in terms of the organically. And that's an issue for a lot of big companies. And AngloGold is not as big as Newmont. And you could see the other big thing is that the increase in their resource growth. So a third of their overall resource growth here was just the acquisition. All of that increase in reserves was acquisition. So that's what sentiment did for them. And so if we look at our example, our case study, let's say, is Newmont. So Newmont, the mega merger was closed in November 2023. It was a $28.8 billion Australian acquisition, which was announced in May, all share. And that consolidated, I mean, in terms of that ended up being $19 billion US. They also paid another $500 million of just integration and transaction costs over about 18 months. So if we look at the rationale, and this is the rationale, is the same for Equinox, is the same for Anglo, is volume, because they have a hard time growing. When you get up to a certain amount of ounces, geology is just going to stop you. They don't exist, a lot of these big deposits. Exploration takes a long time, 20 plus years from discovery to production, and the tier one assets are getting fewer and fewer and fewer. And so a lot of these guys are looking at more copper gold assets now than gold because that makes more sense in terms of geology. That gives you more revenue, so more ounces, more exposure to gold. I mean, you saw what happened with Anglo. That helps. Prioritize assets because you want to slim down management, but you want them because it takes as many people to manage a big project sometimes as a small project. So you want them to focus on what moves the needle. So prioritizing your combined asset portfolio. So if Newcrest wasn't acquired, Newmont's reserves probably would have been flat. But they can actually get rid of assets, take on Newcrest, and still show an increase in reserves. Their reserves and resource statement is still not out. It'll come out, I believe, in the March. Should come out soon. And the other thing is that they're trying to attract dividends. And I showed you that dividends was the thing that would set them apart from an ETF. But the problem is that they will attract people that want the gold equity ETF leverage and then say, okay, but we offer a dividend. So they might get those people, but they will not get the generalist investor that's just looking for dividends. Because most of these companies, and I'll show you, their dividend policies aren't stable enough for them. So all of this, like any typical financial or economic puzzle, has its constraints. So you're not going to do this to infinity. So you want to maintain a healthy balance sheet. You want to control your share structure, which they blew out, 45% increase with the acquisition of Newcrest, and manage your corporate expenditure, exploration, and also G&A. But it was the biggest M&A. So right now they're sitting at the biggest production market cap company, and probably they might be there for a while. But as we see in terms of their actual proportion in the GDX, which is one of the bigger senior equity ETFs, they're actually very close to Agnico. And Agnico did make that merger, combined merger with Pan American to acquire Yamana, but they didn't buy, almost a merger of equal company. And they're, in terms of proportion, almost the same as Newmont. So this is who you're competing against, which is the equity ETF. But the bigger you get, the bigger proportion you are of your competition. So you move more in lockstep with them, the bigger you get. Because right now, Newmont is about 12% of the GDX. So let's talk about leverage. Okay, so the blue bars are gold production. So this Q3 is the Newcrest merger. So average production quarterly was about 1.46 million ounces. This would be the revenue generated, about $2.93 billion. 50% increase in revenue on a per share basis, a 12% increase. So still accretive because you increased your share count by 45%. So that is a positive. So you can see here the revenue per share, $3.62, got up to $3.93, 8 to 9%, sorry. So this was the increase in share count from 799 million shares to 1.1 billion. And so that in itself was 45%. They're doing some share buybacks, they're getting it down, but I mean, that's a lot to make up. So this is good to get an accretive metric like revenue per share. But again, 45% increase in share count really impacts the revenue per share because you only get an 8 to 9% increase in the revenue per share. This is just the average since the merger was announced and the consolidation, so since the last quarter of 2023 and a full year of 2024. Okay, so overhead. So G&A. So Newmont peaked around 6% of their revenue at G&A. So post-merger, they've managed to cut. And then they're making more money, so the denominator has increased, but they've reduced the G&A such that they tried to maintain at 4%. So that's positive. This is a problem with attracting generalists. So this is your dividend policy over the last 4 years. So gone from 14 cents per share up to 55 cents per share, and now your long-term is more like 25 cents per share. So that can't attract somebody that's looking for a stable dividend policy. They have to show that for an extended period of time before they can attract that kind of investor that they're looking for. But you can see the peak of dividend payout was actually the first quarter post-merger, because that's when they increased the share count by 45%, and they had to reduce the dividend policy to 40 cents because they couldn't manage a 55 cent per share dividend policy with a 45% increase in the share count. And so the balance sheet. And so this is December 2022, end of year, December 2023, December 2024. Metrics like working capital, long-term debt, net debt. Reclamation is important because you're taking on more assets now with more liabilities. And then this is the value originally of the assets for sale, and that's the share count change. So you can see that their working capital went down 60% post-merger. Their net debt went up 174%. So this is what they had to try and fix. So the divestitures that we'll go through are trying to hit that and improve their balance sheet. So you can see here that post the end of 2023 to 2024, so they had a full year of the merger, they managed to increase their working capital by 213%. A lot of that was cash from sales from the divestitures. And their net debt was up, but increasing at a lower rate. Net debt was down by half. Very important. So they're working their way to clean up their balance sheet. So in terms of their share buyback, so here I showed you down here, 45% increase in share count. Their share buyback reduced their share count by about 2%. So not a huge impact. Most of the buying was in the tail end when they were going up. I'll show you that later in the share price, but they paid about $48 per share. They bought about $1.24 billion of shares in 2024. Okay, so we can talk about the rationalization. So as soon as they got the companies together, 13 operating asset core. So that G&A was going to manage 13 assets on 4 continents. So the big development projects, the growth for them now is in Australia. The Cadia project, Cadia is underground, Macquarie Arc, Tanami, West Australia, and Ghana, Ahafo North. And so what then they looked at and developed very successfully a short-term, high-octane plan of divestiture of not only their non-priority Tier 2 assets, but also those of Newcrest. And so this is a timeline. These are the assets sold, cumulative of what they sold. And you can see that they started off, what was easy was the Fruto del Norte stream. They sold that to Lundin Gold. Batu Ijau contingency payment that they had after the sale. And then they started selling assets. This is all inventory, no reserves here. Telfer in West Australia. Then Achim was a big one, Tazijin. Then we had a whole bunch of knocked out here. Musselwhite, Eleanor, Cripple Creek, Porcupine. And that cumulatively, their target was $2 billion. They ended up getting over 4 because of the 25% increase in the gold price, increased sentiment for gold assets. And the actual operating assets, the things people were waiting for, the producing assets, were about 3.8 billion. Okay, so everybody keeps a number in their balance sheet. Assets for carrying value of any assets, of any operation. So they have the assets and the liabilities. So I took the net assets minus liabilities, what they were holding for their assets for sale. And so you could see these were all the operating assets. So Achim was the one they sold at the biggest premium from the holding, from what they actually hold in terms of their cost. And Porcupine was the biggest discount. But overall, they managed to sell at a slight premium, 16% of their book value for these projects, what they hold in terms of assets versus liabilities. So that was good. So here's the divestments. And, you know, when I worked for Newmont, this is a long time ago in the 2000s, the first CEO that I worked for, he was an oil guy. So it was all about reserves, growing reserves, never sell production. But you can sell production if you're taking on production, which is what they were going to do with Newcrest. So they sold 7.6 million ounces of reserves and about 23.67 million ounces of total mineral inventory in 1 year. And so if you look in terms of cost or sale for them, so this would be the number for the total mineral inventory The total here would be what they sold per proven and probable. So Akyem got the biggest number, operating asset in Ghana, followed by Musselwhite, Eleanor, and then down the road. So the average that they got was about $160 an ounce for total mineral inventory, which right now is about the going rate. They got about $440 for reserves. That's probably low, but because there's companies and projects like this that get a lot more. So with all that, what happened? That's what happened. So this is from 2023, end of 2023. The black line is Newmont's index share performance since the beginning of 2024. And this is the GDX, what they're competing against. So post-merger, they were basically in line until October 2024 when they announced their Q3 earnings. Problem was that there was embedded in there potential for cost escalation. That did that. So since then, they've been underperforming. So you could say, well, that was a big waste of time. So if you look at the revenue per share, like I showed you, that was accretive. But if you go to free cash flow per share, it wasn't accretive. So this is their free cash flow per share average in the quarters up to 2020 before the merger per share. Share base of about 800 million shares. Volatile, but an average of 64 cents. Increased the share count 45%. You have some negative free cash flow due to the consolidation. It's about 47 cents, so a reduction of about a third. Encouragingly, if they can manage and keep that up there, I'd be wanting to see a number going forward higher than it was before. That would be encouraging going forward after we have another year of consolidation. So these sort of graphics and this sort of data is what you also want to do in terms of the Equinox and Calibre merger. Look at this on a per share basis to see if it was really accretive and it made any sense. All right, I think I'm done. Thank you very much.